Hey everyone, my name is Nima. We're back again with another Z Investor Sit Down. And today I'm pleased with the opportunity to talk to Brian Feroldi. He's a senior writer at The Motley Fool and creates content on YouTube and Twitter. He's also got a book upcoming next month and available for pre-order right now called Why Does the Stock Market Go Up? He's on a journey to spread financial wellness and master the art of investing. Brian, I'm super happy to have you on and it's great talking to you.
Nima, thanks for having me.
Yeah. So that introduction probably didn't do enough justice to you. So could you please explain to our listeners a bit more about your journey into investing and also creating content for the masses about educating them?
Sure. Like many people, I was taught nothing about investing or money in school. I kind of was forced to figure it out all on my own. I mean, my parents certainly lived a relatively frugal lifestyle compared to what they could have, but it's not like I got a sit down education that was like, here's what you do, and kind of explained how money works and what it is. So in 2004, when I graduated from college, I got my hands on my first ever financial book. It was called Rich Dad, Poor Dad. And that was the first book that opened my eyes up to the topics of everyone's investing for themselves. You can become wealthy in one generation. The rich think differently. The rich buy assets. They avoid liabilities, etc. So that was an eye-opening book for me. And that just kicked off a love affair of investing and discovery about everything that had to do with money and personal finance. Now, I worked at a medical device company for about 10 years, from the startup phase all the way through the IPO phase. And that company is now currently publicly traded. Sheer luck that I got involved with that company when I did. But that company worked out extremely well. And I was really happy for the opportunity. One wonderful thing about that company was I was in sales for that company for the majority of that time. And I was in my car 30 to 40 hours per week driving around. And I used that time to listen to every audio book, to listen to investor conference calls, to listen to Motley Fool podcasts, et cetera. So I really got a university level degree on investing and finance while driving around in my car. In 2015, the Motley Fool I was afforded the opportunity to write for the Motley Fool full time, which I jumped at, and I've largely been doing that ever since.
That's awesome, Brian. So would you say that reading and consuming content from others was the best way to learn investing?
Oh, that's one of the ways to learn about investing. The best way to learn about investing is to put money on the line, to put skin in the game. I mean, nothing teaches you faster than seeing your portfolio go down hard, and you happen to see the financial consequences of your decisions. But I would say skin in the game combined with just a love of the subject and just continuous learning from some of the greatest investors that are out there. That's really the way to turbocharge your knowledge.
Yeah, I totally agree on that. There's no better way to learn than actually starting. Experience is the best learner. Now, of course, you write for the Motley Fool, and of course, they cover a ton of different businesses and stocks and portfolios for retail investors to look at. So how do you usually go about covering a business or the sort of checklist that you follow when writing or analyzing a stock for the Fool from scratch?
So one of the things that I became a paying member of the Motley Fool myself about 14 years ago, something along those lines. And I was just blown away with the quality and the level of the research that they were doing compared to what I was doing. And it really opened up my eyes to what like actual research into a company actually looks like. Now, if you become a member of the Motley Fool, one great thing is you get a ton of recommendations, but one downside is it's not like everyone has unlimited capital to buy every single pick that they come out with. So what I was doing in my own head, what I was filtering their recommendations, as well as some other companies that I was interested in, according to parameters that I thought that were important to me, but I never actually took the time to write them down. And eventually it just became overwhelming with the amount of good ideas that you had versus the amount of capital. And I was trying to figure out, well, which one should I actually invest in? Eventually, I got smart enough to write things down and to create a system for myself. And I would recommend everybody watching this do this for themselves. Step one is to write down all of the attributes in a business or a stock that you find attractive. Like what attributes, if this company had it, you would go, yes, thumbs up. It could be revenue growth. It could be margins. It could be addressable market. It could be moat, could be management, could be the stock performance. I don't care what it is. Just write them down. Then write down a second list. What are the things you don't want to see in a stock? For me, that's things like high stock-based compensation, customer concentration in a declining market, being disrupted. A huge amount of the profits are derived in foreign currencies, so that makes currency moves up and down, etc. So take your two lists and then rank them top to bottom as most important to least important, and then apply some type of scoring system to your attributes. So that's what I've done for myself, and it scores many of the attributes that I just listed there. And what this allows me to do is to take any company that I come across and I can put it against this scoring system to see how closely aligned with my investing style this company is. So it's not necessarily finding the best companies that are out there. It's finding the ones that are the best fit for my investing style. Then when I'm going to build my portfolio, I look through the list of companies that I've run through here, and I'm buying the ones that are the highest quality according to my parameters, as well as the ones that are the most attractively valued, plus the ones that have the highest long-term potential. So it's the combination of those three things that show me where I should put my capital at any given time.
Yeah, that's great. I feel like a lot of decisions made on the market are very qualitative now, emotional, and not very quantitative, as you said, assigning scores and basing something based on your values of investing. So that's definitely a framework that is something that should be global across many retail investors. My next question is that it kind of wedges into that one. Are there any specific properties, and I guess it's a personal question, any specific properties or attributes that specifically for stocks or businesses that you feel like are important or sometimes even underrated that people look out on, or even overrated? People, hyping up low PE or really trying to push like quarter beats or anything. What do you feel like are some of these properties or attributes?
So the ones that score the highest, or the highest scoring on my particular checklist, number one is the company's competitive advantage. If you don't have a competitive advantage, or a moat as it's called in some way, I'm not interested in you. Like capitalism will almost assure that you will fail at some point if you don't have something about your company that makes it special. One other one that I score, one of the highest scoring on my list, is something called optionality. And that is a hard thing to kind of figure out. But what optionality is a company's ability to innovate and open up new revenue opportunities for that company over time. So when I look back at some of the biggest winners that I've ever bought, almost all of them have some amount of optionality built into them. When I was buying them initially, it turned out that later, maybe a year, maybe 3 years down the road, they launched a new product or a new service that opened up a brand new market opportunity that I couldn't see in my analysis 3 years ago. So some easy examples of that would be Amazon, with Amazon Web Services. When I first bought Amazon Web Services, when I first bought Amazon Web Services was a tiny portion of the company's overall revenue, and basically not something I was buying the company for. But if you look at what Amazon Web Services has done, it's now the biggest contributor to Amazon's profits by a country mile. So that's optionality. It's buying a company that is innovative and can adapt to the market so that its revenue and its opportunity can grow way bigger than any potential spreadsheet could capture up front. So those are two categories that I place a particular emphasis on.
Yeah, definitely. That second one is, I feel like, what distinguishes really good winners and normal winners in this market, trying to not predict the future, but see different avenues that different companies have. So yeah, I totally agree with your answer, Brian. Now, on to the next question. Something that both the Motley Fool and any other media service around investing has today is just a huge surplus of information about different sectors, businesses, stocks, speculations, and news, and all this stuff going on in the market. And it especially applies right now in this day and age when we have things like record high inflation rates, supply chains, wars going on. So how do you feel like you kind of filter out this noise, whether it be through this framework you were talking about earlier, or just making sure that you're not contributing to any sort of emotional trading with this huge surplus of information?
That's really hard, easy to say that you can do, and it's really hard to do in reality. The way that I focused on that is I have internalized and 100% believe with every ounce of fiber that I have that a business will ultimately be valued based on what happens to its financial statements, right? If a company's revenue and profits grow substantially, 100-fold over the next 20 years, you can be sure that that company's stock will be higher than it is today if you bought and hold it over those times. Conversely, if you buy a stock today and that company's revenue and profits get cut in half over the next 10 years, you're going to be assured that you're going to do pretty poorly, even if you pay a very low price for that company today. So that is the long-term theory of how businesses will be valued. They ultimately follow what happens to the underlying companies. However, that's what happens in the long term. In the short term, absolutely anything can happen, and this drives so many people mad because it seems like a business can be thriving, revenue can be growing, margins can be improving, and the underlying stock can just get hammered for what seems like random reasons. And the exact inverses can be true. A company can be muddling along, and for no reason, its stock can just double. Benjamin Graham's quote on here is just so applicable. In the short term, the stock market is a voting machine. In the long term, the stock market is a weighing machine. So the way that I ignore all the voting that goes on is by focusing on the weighing. So when a stock moves significantly up or down that I own or might not want to own, I don't look to just the stock price movement. I always look at the business performance. What is the news that caused the big stock price move? And importantly, what happened to the company's profits and revenue in the most recent quarterly report? As individual investors, we're going to always have numerous disadvantages when compared to the markets in general. We're going to be slower, far slower to react than they have. We're not going to have access to management. We're not going to have access to the same amount of information that the market does. So in many ways, it's folly to think that we can beat them at their own game. The only advantage that individuals have over professionals is time. We have permanent capital, right? We're not going to fire ourselves if we have a down quarter or a down year or anything like that. We have permanent capital, and that allows us to truly invest with a long-term horizon in mind, a multi-year time horizon. So while most of Wall Street overly emphasizes the short term, whether it's to the up or the downside, investors that are managing their own capital can truly look out and think to themselves, where could this company be in 5 or 10 years if I'm right about the business? So that is where I keep most of my effort and most of my attention. Plus, it's just so much more enjoyable to invest that way. So many people go crazy trying to dig over the most recent stock price movement and what's happening with the Fed or inflation and look at this data and try and guess what's going to be happening to the next. I don't play that game at all. I say to myself, is the business fundamentally strong? Is it going to get stronger over time? And if I'm right about that, how much money could I potentially make? That's what I focus on. And I just have, if you do that for long enough, you just develop an almost indifference to what's happening in the stock market on a day-to-day basis. In fact, if you look at my Twitter direct messages, it's very common for me to somebody to say, what happened to ABC, whatever stock today? And my answer is like, I don't know. Like that's not what I'm focused on. After a day or two after a company reports earnings, that's when I typically look through it to look to see if my thesis is still on track. If the answer is it is, I don't make any decisions other than potentially to be add. If my thesis is looking like it's busted, aka a report comes out that says maybe I'm wrong, maybe my analysis is wrong, that's when I'm going to take action. But the only advantage that I have over the market is long-term time horizon. Period. End of discussion. So if I tried to, if I took away that advantage by trying to be faster than the market, I would almost assuredly lose.
That's an excellent way of putting it. Saying that retail investors have one thing over Wall Street and whatever else that stocks are being issued to, it's that you have long-term capital. So if that's the only strength you have and you're trying to play the short game and swing trade and all this different type of stuff, then chances are you're going to end up losing. So that's I've personally never thought of it that way, how the only advantage you have is long-term capital, but that's a really great way of putting it, Brian. Yeah.
And it sounds small. It sounds tiny, but it's a massive advantage. The way I like to think about money management is it's a lot more like politics than it is about finance. I mean, if you're a money manager, if you're managing somebody else's money, how do you make more money yourselves?
Mhm.
The answer is manage more money. Therefore, you get paid more if you have more assets under management. So you could do that by raising more capital from investors or growing the assets that you have. And again, it's kind of like politics. Like if you asked any politician, what's your job? The job that they will say is to serve my constituents, right? I'm here to serve my constituents.
Yeah.
What's their actual job? To get reelected, right?
Yeah.
It's a conflict of interest based on what they're trying to do. The exact same thing is true of management. Ask a money manager what their job is, and they're going to say to perform blank service for my clients. What's their actual? How do they actually get more money? The answer is raise more capital. Now, obviously, they want to outperform as well. But if push came to shove, most money managers are focused on their bottom line, and their bottom line is what's happening with the market this week, this month, this year, this quarter, and how can I convince more people to invest with me? As an individual investor, you don't have to think about any of that, right? You don't have to focus about how am I going to explain what I've done to somebody else? How am I going to justify that? And can you imagine trying to be in like Cathie Wood's shoes right now? I mean, I think that Cathie Wood's strategy, broadly speaking, is something that I agree with. I love that she invests in disruptive innovation, but her funds have been under so much selling pressure over the last year simply because her style of investing is way, way out of favor. And she has to go on CNBC continuously and say, it's going to be better. Innovation wins out. And yet still people are pouring huge money from her funds. So she has to commit so much of her time into convincing her investors that her style of investing works. As me, I don't have to spend any time convincing myself that my style is going to work, even though my fund is down pretty substantially over the last year, given the rough sell-off in tech stocks. So if that sounds like a small advantage, it's not. It's huge.
Yeah, definitely. Now, personally, you said you advocate a bit for Cathie Wood's sort of looking for innovation type of stocks, and also on Twitter, you've mentioned a bunch of different type of sort of investing disciplines. Like you said, dividend investing is kind of an indicator of companies that used to be good, but now aren't really. You've also said that, you've also written about a bunch of growth stocks, and you've also said that value investing doesn't pay off investors as frequently as it used to. So could you kind of provide a bit of insight and like contrast between all these different types of investing disciplines and techniques that are used now? And also, like, I don't know, there has been sort of a surge of like flirtatious value investors, and also many sort of growth stocks, especially if you're on Twitter. So could you provide a bit of information, insight on that?
Sure. So the quote that I think you're thinking of is a high dividend yield is a sign that a company used to be great, but no longer is. And what is a dividend yield? A dividend yield is when a company's pays out a certain amount of its profits to its investors, which is good, right? That's a good thing that a company can do that. However, a high dividend yield sounds attractive, right? It sounds like, look at this company. It's got a 4, 5, 6% dividend yield. How can I lose, right? I'm going to be paid this for just owning this stock. Well, the reason companies have high dividend yields is because typically they're paying out almost all of their profits back to investors because they have no better use for them. And two, their share price has been under selling pressure. The valuation is not high, which indicates that the market by and large thinks that the company is no longer going to be in growth mode. Now, does that mean that all high dividend stocks are bad? Of course not. There's going to be some of them that outperform, but by and large, there was a period of my life when I was very attracted to high dividend yield stocks. And if you look at companies that high dividend yields today, it's like IBM, it's like maybe General Electric used to be in that category. I can't even think of them off the top of my head, but there's companies that have very high, AT&T, that's another one, very, very high dividend yields. And it is very attractive to a lot of people to buy these stocks, but that dividend is a component of return. It's not the entire rate of return. And broadly speaking, if a company has a high dividend yield, that means that its glory days are over and the investors are largely going to be milking that company for just the dividend. And oh, by the way, if that company's core business is under attack, which is many cases for these high dividend yield stocks, that company's dividend will eventually be cut because the company will no longer be able to pay it. So that's my thoughts on high dividend yield stock. As much as I used to be attracted to them, I've just learned the hard way that many of them are actually really, really poor investments. When it comes to value investing, there's like a dichotomy between growth and value that tends to exist. I'm in Warren Buffett's camp that I think they're more the same thing than anything else. But broadly speaking, if you follow like Benjamin Graham and what he taught and value investors teach, they're trying to buy 60 cents worth of value for, a dollar's worth of value for 60 cents. And when their 60 cents comes up to 90 cents or 95 cents, they sell and they move on to the next thing. And obviously there's a lot of appeal to that style of investing. But I've found for me, what I would rather do is I would rather pay $1, $1.20, $1.50, or even $2 for something today that's worth $1 that I think could be worth $10, $15, $20 in a couple of years. So that's the kind of style that investing that appeals to me, where I have to make essentially one decision about a company and then wait for that company to execute. And if I'm right, I can earn multiples on my money without having to take any other action. There's no right or wrong way to invest. Dividend investing is a good strategy for some people. REITs or master limited partnerships is a good strategy for some people. Value investing is an investing style that works for some people. So everyone just has to figure out what kind of investor they truly are and then focus on that.
Yeah. Do you feel like value investing is a bit, I mean, obviously it's harder, but do you think it's practical in this sort of market right now, where everything is almost everything with any sort of value metric is overvalued?
So again, value investing, historic value investing, the concept is incredibly sound, right? It's buying something for today for less than it's worth, and the value capture in between there is not only a margin of safety, but it's also a return booster. So I don't think that will ever go out of style. And if you look back at the last 10, 15 years, value investing, that style of investing, has been out of favor, and growth investing has been in favor. However, those styles of investing cycle in and out. What's been out of favor over the last year? Disruptive investing, high growth investing, that's been way out of favor. And REITs and energy and banks, those have been in favor. So these things always go in cycles for each other. Now, if you told me the year was 10 years from now, 2030, and you told me that value outperformed growth, I would believe you, and I wouldn't be shocked, because again, those things go in waves, and value investing has been so out of favor for so long that I could see it being more in favor moving forward. But then that gets it. What is value? Is Coca-Cola a value stock, even though it's trading at 25 times earnings, or is CVS a value stock? Or what is a value stock? Those companies still have to grow for them to be worth investing in. But even if that was the case, I don't think I would change much about what I do personally, because my style of investing is to find dynamic, high growth companies that are very high quality and can substantially grow their revenue and profits over a period of years. There may be the case that style of investing is just out of favor for like a multi-year period. If that's the case, I'm going to underperform, but I'm okay with that, because I still want to own the best companies that I can find, period. And I don't want to own any of the companies that I don't think are worth owning. But it's just important for investors to realize that it's natural for these things to cycle, and that anything could happen over the next couple of years.
Yeah, that definitely makes sense. I feel like it's more important for individual investors to have their own framework set for themselves, rather than be defined by whether it's time to go value or it's time to go growth in specific market periods. And that just sort of, it essentially is just another form of timing the market, which we all know doesn't work out very well. So yeah, this is a personal question from me, but I wanted to ask you about C Limited and their recent quarter release. And I was personally very impressed with the earnings, and I loved your reaction when you read that they had probable profitability in the future in your video. I really liked your reaction, and I was wondering if you had any more thoughts on the future of the company. And if you're watching this, you should definitely go watch Brian's video on C Limited and their recent quarterly report.
So C Limited was like a very much a COVID stock of sorts, right? So the three main business lines are video games, which were very much COVID friendly, electronic payments, very much COVID friendly, e-commerce, very much COVID friendly. And this company's growth has been hyperbolic, right? Triple digit top line growth. And this is just a quintessential example of a company that was like positioned incredibly well to do very well in the 2020. So we saw this company's valuation just get stretched and stretched and stretched, because it's a very, very attractive company. I mean, it was all of, last In December of 2020, I see the company was trading at 26 times sales, 26 times sales. For every dollar in revenue, investors are paying $26 for the company. Now, what's happened more recently, that style of investing, the company like C Limited has just become unattractive to the market in general. And we've seen this stock serially underperform over the last year. More recently, in their most recent quarter, they told us that the video game division, which historically has been their cash cow that's funded their other things, is going to be having a down year. Now, that makes sense. Video games are not as popular this year as they were last year, given what's happened with COVID. And Seagum also said that their other businesses are going to remain in growth mode. But when you combine those together, the top line growth is going to be going from 100% per year to like 30% per year. And that's something that makes some growth investors puke, that kind of significant deceleration. But if you were to just look through the company and say, is the thesis, are the reasons for owning this business still the same today as they were a year ago, 2 years ago, 3 years ago, 5 years ago? The answer is yes. This business is clearly stronger today than it was at any point in its past history. However, the vicissitudes of the market show that what happens to a business and what happens to the stock could be miles apart for short periods of time. So I personally do not own C Limited, not because I didn't think it was a great company or anything like that, simply because I thought there were other opportunities out there. But this one is rapidly entering my watch list as a potential buy.
Yeah, definitely. Yeah, the point you said about the 100% growth to 30% growth is really important, I feel like, and not something that a lot of people see, especially their money's growth. It's sort of like a double-edged sword at this point. And it's definitely on my watch list too, and I've been following it for some time. So yeah. This is a general question coming from our community, but what do you feel like is the most neglected piece of investing wisdom that beginners get told?
Neglected?
Yeah, I guess what they meant is like ignored or something that people glance over.
Boy, I mean, there's so much investing wisdom that gets thrown out there, and it depends on what kind of beginner went you are. I mean, I can tell you, just speak for myself. When I first started investing, I wasn't following any advice. I was just trying to buy stocks that I thought were going to go up tomorrow, the next week, the next month. Like, that's it. That was all I was trying to do, was make money now. And it's very tempting to do that, right? Because the stock market gives you immediate feedback, right? You buy something, and 1 second later, you know if you're up or down on your position. An hour later, 2 hours later, the price is going to be different than you paid for it. So you get feedback whether your decision that you'd make is right. But in reality, stock price gyrations are actually huge normally. I recently saw a study that showed in normal years, so non-recession years, non-bear market years, the average stock price gyrates by 40%. On average. So like a stock will trade between, let's just say, $80 per share and $100, $120 per share. That's the normal gyrations in a normal year. In a bear market year, the average stock gyrations are up to 120 to 140%. So if a stock's at 100, it could go from $40 per share to $140 per share. Just enormous moves. But those moves tell you nothing, don't reflect the underlying fundamentals of the business much at all. That's just the market moving up and down. So if you buy that stock for $97 and then that same day it's trading for $98, it's natural to tell yourself, I made a good decision, right? I'm up right now. But all you're doing is fooling yourself by the randomness that happens when stock prices move. It's really a multi-year period that you actually can tell whether you made a good decision or a bad decision. So that's one of the downsides to the market, is you get immediate feedback, but that immediate feedback is also often a false positive to whether you made a right or wrong decision. And it's only measured over long periods of time that you can tell whether you're doing the right thing or not. However, I didn't know that when I first started, right? I thought the whole goal was buy low, sell high, right? Buy low, sell high. That's what so many people are taught in the beginning. And again, because of that immediate feedback you get, it's natural to fool yourself into thinking that's what the aim of investing is to do. So I would say that is something that people look at and aim to do early on, but that's not really investing.
Yeah, definitely. Now, just another question from our community, and also just one I also wanted to ask. I'm not familiar if you've covered this yet, but Facebook's earnings around last month kind of shocked the market a lot, and especially seeing such a high cap stock trade like a crypto coin kind of got a lot of people worried, or not worried at least, but surprised. I personally was expecting their earnings to be bad, but not that bad. So could you maybe provide your thoughts and opinions on that recent sort of release?
Sure. So Facebook is a stock that I've owned since 2012.
Yeah.
So I bought the company essentially a few months or a few quarters after it came public, simply because it checked so many boxes for me. And Facebook's financial performance have been nothing short of amazing, like just nothing short of amazing. The company has put up like 40 or 50% growth for many, many years. And even in the most recent quarter, which was a disaster, it's ridiculously profitable. The company is just cranking out profits and cash flow like you wouldn't believe. It has one of the best balance sheets in the world with tens of billions of cash, zero debt. Love him or hate him, Mark Zuckerberg has been proven to be a very effective, highly competent CEO that has a savvy for making acquisitions. I mean, hello, Instagram. I remember when they bought Instagram, I was thinking, what the heck are they doing? What a use of capital to buy this company.
Optionality.
Yeah,
Right.
and it was a genius move. Like, it was one of the best acquisitions that could possibly have been made. But the sentiment for this stock has been low for quite some time, just given all the headwinds around social media and people's views of it, and how it affects elections and all the negative aspects that social media has. And then when you combine that with this quarter, where they're basically saying the changes because of Apple are going to cost them $10 billion in revenue this year, plus they're making an enormous bet on the metaverse. Like it or not, that is what Zuck thinks is the future of this business. That's a hard pill for a lot of investors to swallow. But as an investor in Facebook for many years myself, I have not sold a single share. And the potential optionality of the metaverse is really interesting to me. Is it going to pay off? I don't know. I think they have a decent shot about making it pay off, but so for me personally, I'm not selling any of my shares, especially at today's prices. But I understand why there's a lot of pessimism in the stock right now.
Yeah, I was about to ask you about the optionality of the metaverse, and I definitely agree with you on that. The way I think of it is that the acquisition of Instagram and the idea of Instagram itself was something very foreign to people at the time. Social media and posting photos on the internet, but it turned out to be something with over 3 billion users and basically a centerpiece of a lot of people's lives. So now that people are kind of speculative and a bit confused about this whole metaverse thing, there's no denying that with Zuckerberg in charge and all that type of stuff, soon enough, it may just be mainstream. Now, in regards of their declining users and also like reinvesting so much capital into this metaverse thing, does that also sort of concern you, or sort of like nudge the fundamentals of the business a bit, because they're kind of pivoting a bit towards this meta? I mean, they literally rebranded themselves to Meta. Does that concern you a bit about the underlying business itself?
So the underlying business, the business itself is still strong. Yes, the declining in user engagement is certainly a metric to watch, and there's no doubt that TikTok is having a big impact on basically all social media companies, including Pinterest, including Snapchat, including Twitter, including Facebook. Like TikTok has just been a phenomenon that's taking over, and the jury is still out on what the long term is gonna happen with that. But I could just speak for myself. So I still use Instagram all the time personally. I still use Facebook at least monthly for no other reason than to check to see whose birthday it is, to check in on some Facebook groups. And Facebook Marketplace is actually a super useful service for people to buy and sell used goods. It's essentially eaten what Craigslist used to be. So I still think there's plenty of value in Facebook's core underlying business. Now, whether the big bet that they're making, and boy, are they making a big bet on the metaverse pays off, that I don't know. But I know that this company certainly has the capital to make that investment. And if they can make it work, it could be a massive winner for the business. So that is just like potential upside that I still want to see if that works out. But it could be a complete waste of capital. Facebook's core business could be in permanent state of decline. I don't know enough to make that call yet, but I'm saying for me, for myself, I haven't seen enough to convince me to sell out of this company yet.
Awesome. All right. We have 2 more questions left. So yeah. This one asks, what's one tool or piece of software that you use most while investing? So the first one that comes to mind for me is like TradingView, but and I personally feel like you don't need like a lot of software or these complicated tools to invest properly. But do you use any of these sort of software terminals or anything to help advance you or screen stocks?
The tools that I use the most are SEC filings. So mostly, which are accessed mostly through the company's investor relations page themselves. So if I want to research a company, the company's website is the first place I'm going to, and where I'm going to spend 90% of my time. Beyond that, I use Google Sheets to track a portfolio of watch list of stocks, as well as my portfolio itself. And then I use some other websites to track potential ideas. One site that I get access to as a Motley Fool employee is Y Charts, and I can pull up long-term charts on companies' metrics. So I'm looking at long-term revenue growth, the stock performance, margin profiles, returns on capital, those kind of things. So I think that that's pretty good. But I also use Yahoo Finance regularly to just get some quick market data on companies, and Google Finance too. But there's lots of wonderful tools out there that are free for people to use. So we're really spoiled today with the choices that we get.
Yeah, just a follow up to that. In terms of SEC filings and companies' documents, what's the first document that you go to personally if you're interested in a company? Is it, I mean, the first thing that I think of for me personally is 10K filings,
Yep.
But yeah, 10K. Yeah.
It depends on the company, right? So it depends on when they pump it. The ideal scenario would be a 10K that's very recent, and the company's DEF 14A, which is their proxy filing, which tells you inside ownership. That's not always possible, especially for IPOs. So for an IPO, I'm going to go to the S1, or even better, the S1A, or even better, the 424B4, which is a stupid name for a document, but that's basically like hey, we came public. Here's our updated financial statements after we came public. So it's a really useful document. And that will also tell you inside ownership, as well as the basics of the business. But you can learn just so much about a business by reading through its 10K.
Awesome. All right. And last question. So most of our audience, as I mentioned earlier, is around the young adult range, the 16 to 20, some older, some younger even. And if you could offer one piece of financial wellness to them that you didn't have at this age, or you wished you were told at this age, what would it be? And of course, on Twitter, you post wealth hacks and all of these sayings that sort of inspire people to strive towards financial greatness. So I was just curious about that, and I feel like you could offer great advice to our community.
So I'm a massive fan of investing, right? This is where I spend a lot of my mental energy and what I look on. However, I fully admit that what you do with your personal finances is actually an order of magnitude more important than what you do with your investing finances, especially when you're just getting out of college or just getting out of school and you haven't really had time to develop your career, grow your income, and you still have tons of expenses ahead of you related to housing and marriage and kids and cars and all that kind of stuff. So the best investment that people can make early on in their career is early on out of school is to develop their human capital. So do things you can to increase your income. And then importantly, those success that you have increasing your income, make a habit of taking a portion of that and an increasing portion of that and putting it into productive uses. So that could be paying off debt. That could be building an emergency fund. That could be investing in the market. So that's definitely by far the number one thing that people should be focused on, is growing their income and using their excess capital to make their personal balance sheet in as good a shape as possible. It's only from that position of strength that you can really start to invest in the market the right way. Because if you put money into the market and you also have consumer debt, and then you lose your job, which, by the way, is most likely to happen when the economy is doing badly and stocks are down. If you're forced to liquidate your portfolio, it doesn't matter how good of an investor you are or how well you've done over time. If you're forced to sell your stocks to pay for living expenses because you didn't plan properly with your personal finances, your returns won't matter because you'll be selling stocks at depressed prices. So do everything you can to set up your personal finances so that you can leave your investments alone for years.
Awesome. All right. I guess that wraps it up. And thanks, guys.
Thanks for having me.